we came close to having to close up the business. For example, when COVID happened, people don't forget there was this 6-week period during COVID where the world almost stopped, right? We had this investor try and effectively do an aggressive takeover by putting the term sheet on us and effectively saying, look, we'll get another portfolio company to buy you. The attraction of a business like this, an infrastructure business, is that we have B2B costs, but we have B2C margins. Stablecoins are growing massively. That's why people are so excited about it, because despite it being a largely unusable technology, people are using it. So as we solve usability and reduce friction even further and create connectivity around the world, it's going to explode in terms of usability. You know, our chief business officer sometimes says no business is better than bad business. And I think it's actually true.
Welcome to Fintech Leaders. I'm Miguel Armaza, and I'm fascinated by the companies reshaping financial services, which is why I co-founded Gilgamesh Ventures, a fintech fund where we have backed almost 50 fintech companies worldwide. And over the last 5 years, I've recorded over 350 conversations with the top leaders in fintech to extract how they think, what they've learned, and insights that can be helpful to builders in fintech. My guest today is Edward Woodford, founder and CEO of ZeroHash, one of the most notable and important infrastructure companies in blockchain and crypto that is also one of the least visible ones for the consumer. ZeroHash powers financial infrastructure and works with companies like Stripe, Franklin Templeton, and Interactive Brokers. They've raised hundreds of millions of dollars from great investors, and most notably, they recently rejected a $2 billion M&A offer from MasterCard, something that very few founders and companies would dare to do. I think it's going to be a fascinating conversation where you will learn a lot about the future of financial services as it intertwines with blockchain and crypto. Thanks for joining.
Yeah, thank you.
Met you a couple of years ago. Have always wanted to host you, and I think this is the right time because you just rejected $2 billion. I don't know anyone who's done that. I don't know if you can talk about it, but maybe just tell us a little bit about it.
Yeah, I mean, look, maybe I can talk at high levels. I mean, we
Yes.
put out a public statement and, my view is that, I've been doing this since 2017 and I am a really true believer in blockchain technology and what it can do. I just fundamentally believe that what we can do in the next 2+ years will dwarf what we've done in the last 8 years. And as a founder in a new space, we've been waiting for the dominoes to fall. And it just feels that every domino is accelerating. And as we sat back at the end, in the middle of Q4, we were on a record. We had a record year. We had a record quarter. And it's, you take a step back and you're like, why am I doing this? And it's not cheesy. It's like, I actually believe it. And we've actually shown that we believe it, that one, we believe we can be significantly bigger. Two, I believe that as an independent business, we can have materially more impact. And that's the quadrant that you make a decision by, right?
Yeah.
So yeah, look, it's an interesting one, but it's something that is actually a very easy decision. I'm excited by the future, and sometimes when you go into like a process, like an acquisition, it can be really, really tiring. And the energy to say, look, we're actually going to take a bigger swing and try and accelerate the momentum we have. It's like it's revitalizing, right? It's like you almost fall back in love with the business.
Takes massive balls, man.
Yeah, and look, apart from like the emotional side of it, there are like you can't just go off emotion, right? Like just the practical realities. One, we've been doing this for a long time. So I do think that there are options now around secondaries and there are great options for your team if you want to do that. So one, you can reward your team materially and there's the structures to do that. Secondly, the macro has shifted. The interest institutionally, the ability to go public. We were talking, just before we started around companies going public. That's opened up as well. So, take away the emotion, take away our thesis. There are practical ways to, one, make sure your team get rewarded. And two, as you look towards the future, an exit path that looks even more exciting, right?
Is there also an element of what else would you do? Because I think a lot of us have heard the story of Facebook rejecting $1 billion acquisition offer, maybe from Yahoo or Google, I don't know who. The rationale for Mark Zuckerberg was, what else would I be doing if I take all that money? Great, but he would just build Facebook again.
Yeah.
Right? So for you, is there an element of that?
Yeah, I mean, I really honestly try not to associate my complete identity with the business.
Okay.
And I think that's partly come from, over the journey, especially in this space that we've been in, we came close to having to close up the business. For example, when COVID happened, people don't forget there was this 6-week period during COVID where the world almost stopped, right? And we had this investor try and effectively do an aggressive takeover by putting the term sheet on us and effectively saying, look, we'll get another portfolio company to buy you. Stories like that. And so you have to almost separate yourself and identity, otherwise it will completely destroy you. Look, do I lose sleep over the business? Do you worry about the business? Am I as healthy as I could be without? No. But you can't have your complete identity tied up in it. And I think that's partly because in some ways I've almost grieved the business 3 or 4 times. And so you have to have a degree of separation. Look, and also, do I want to spend time with people that just associate with me with the business and our success? That's not who I want to spend time with socially either. So, look, you have to create a little bit of distance between, I think, yourself and the business in order to have a healthy balance. There is certainly an element, right? I love building. I really believe in the space, and I really think we're at this massive inflection point. So, what else is more exciting right now with my skill set, with my knowledge? Yeah, there's probably very few other options. But, one of the pieces of advice I got from my dad when we were talking about different options and pieces is don't be completely wedded to the idea, right? You can do other things if you want. So I questioned and said, do I think, one, this is the best outcome for my team? Do I believe this is the best outcome for me? Do I believe that we can have more impact? And the answer was no. But I wouldn't say it's that's the only thing I can do in life. And I think partly it's because of the experiences that we've had that have kind of created that degree of separation, was have to take off a different hat and almost be kind of removed from your emotions sometimes.
So speaking of your identity, maybe tell us a bit about your background.
Yeah.
Obviously your accent reveals you. You're from London, but you lived in the US for a couple decades, close to...
Yeah, not quite. Well, decade and a half, I suppose.
Yeah.
So, yeah, I grew up in the UK, half Spanish, half English.
Habla español?
Sí. Oh. But not to a level where I can talk about crypto, in the sense that, my mum only speaks to me in Spanish. But she's fascinated by crypto, but I don't know if I'm crypto conversant, if that's something that you can put on your LinkedIn. Yeah, moved here when I was 21, came to grad school, and yeah, I've just stayed. It's a great place to build businesses, and the reason I came honestly was I got rejected from Oxford, and I always say this was best. That was the best thing for me because it kind of gave me this itch to get a pedigree university on my resume, and so for me that was MIT.
Was your British father devastating when you got rejected from Oxford?
No.
I know someone whose father cried when they didn't make it to Oxford. This is a very...
I think I cried.
British.
My parents definitely didn't cry. My dad actually didn't go to university. It honestly was the best thing for me. It gave me a chip on my shoulder. I was got everything good at school, and it teaches you there's randomness to life, and that was a really, really good lesson as an 18-year-old. And I went to a great place, made a lot of great friends, had a great education. So I can't complain. But when you're sat there as an 18-year-old, it is downbeaten, right? That's your goal. That's your North Star. So yeah, honestly, I just came to the US because I wanted that kind of pedigree, and I'd probably watched Love Actually too many times, and came and then stayed.
When did you get interested in kind of the future of financial technology, or just in future of finance?
Yeah, so when I was at MIT, there was a professor there called Kristen Catalini, who really was at the forefront of Bitcoin at MIT. They did a thing where they gave Bitcoin out to every undergraduate student, for example. And so I actually did a class with him, which really got me interested in Bitcoin. Actually, funny enough, the year before me, it was Alex from Deal, who was the year before me. So this class has done a great job of spitting out entrepreneurs. And I always say if you go to a place like MIT and you don't reconsider what you want to do, you haven't really done it right. If you say, hey, I want to be a consultant afterwards, and then you still say, yep, I 100% want to be a consultant, have you really taken advantage of all the options to work? There's nothing wrong with being a consultant. There's nothing wrong with saying you want to be a consultant, but just assessing what you want to do. So for me, it kind of broadened my horizons of, wow, there's this technology, and wow, you can start a business, and people give you probably more credibility than you're due. And founded another business before that, but it was a financial services company again, but I bought my first Bitcoin at the MIT bookstore. And it just came from this class and just kind of gave me a desire to build and kind of get that, I mentioned that excitement again, that kind of core excitement when you start a business. That is an addictive feeling.
Yeah. And the idea of ZeroHash, was it exactly the same at the beginning from what it is today? How did it evolve?
No, so ZeroHash was founded in 2017, and really, Bitcoin was super, super early, and we were trying to build effectively an exchange for institutions. And then very quickly realized that customers were coming to us and said, "Hey, we don't want your exchange piece. We want everything behind the scenes, right? The infrastructure as a service." And it started basically just Bitcoin and ETH. But that technology has now evolved into stable coins, and now actually stable coins is the majority of our business. It's evolved into tokenization, which really could be anything, right? We were talking about companies going public and different things. Tokenized infrastructure, I think, is going to be rewire the way that value is moved globally. So the business has evolved massively, but we actually started effectively as a B2C business. And then we shifted into a B2B2C business, which is often a common trend for B2B2C businesses.
Yes, and a very common story for fintech.
Yeah.
You want to solve a consumer problem. To do it, you build internal infrastructure, and then you realize that infrastructure is way more valuable than what you're trying to sell to a consumer.
100%. And sometimes I say this, and it's great in hindsight when you can say that you had this clear vision, but the attraction of a business like this, an infrastructure business, is that for us, we have B2B costs, but we have B2C kind of margins. So it's a very attractive business from that perspective. Secondly, just reassessing what our thesis was. Our view was that this was going to be a technology that would be fundamentally disruptive to the way that value is transferred, and value can mean anything effectively. Value is transferred. And yes, of course, there'll be these companies 0 to 1 that are creative disruptors. You've seen the rise of Coinbase, for example, a creative disruptor. But our thesis that this technology was going to be a rewiring, then aren't we better placed helping businesses move into the space, right, and help them evolve? And that really was just the evolution of our thesis and kind of how we developed the business.
So you have some pretty large customers. I believe Stripe is one of those. Maybe share a little bit of the flavor, but more specifically, out of all your products, which ones are the best sellers today? Your top 1, 2, or 3?
Yeah, so really we break down the business in terms of 3 core business lines. So the first is what we call trade, and this is effectively what we provide crypto to partners such as Interactive Brokers and Morgan Stanley that want to embed crypto to their customers. And we see a massive convergence here of crypto companies offering traditional financial services products, traditional financial services companies offering crypto. So we act as that gateway to large established banks and financial services companies to offer crypto.
In the US or globally?
Globally. So, for example, Interactive Brokers, large $120 billion plus publicly listed company. They were actually one of our earliest backers. And the reason that I think in hindsight that they invested was actually they made their money. They made their mark on the world with the electronification of markets. And they kind of saw how if you take advantage of technological shifts, you can go from what was a relatively small company into obviously a massive company. So, we're working with a number of banks that we haven't yet disclosed, but groups like Morgan Stanley offering crypto to their customers. The second big bucket is what we call transact, which is effectively the movement of stablecoins. And here we work with groups like Stripe, like you mentioned. We work with groups like Gusto for account payouts. And we do account funding with stablecoins. And we can talk more about stablecoins there. And then finally is tokenization, where we work with groups like BlackRock and Franklin Templeton, providing tokenization infrastructure. The core of all of that is this is technology, people want access to it, and whether that transfer of value be a real world asset or whether it be Ethereum or USDC on Ethereum, at the end of the day, it's just movement of value. But obviously you productize in different ways. So, we have a crisscross of section of customers of startups all the way to globally systemically important banks and really everything in between.
Out of all those 3, maybe let's talk a bit more about tokenization.
Yeah.
In my opinion, that's the least understood by the public. And we might be at the beginning of a wave of, just a massive amount of tokenization of equities or other financial assets. I think most people do not understand this. Just give us a tokenization 101.
stablecoins are effectively tokenized dollars. I think maybe just some thoughts on tokenization. So effectively, tokenization is a mechanism, a ledger of ownership that is decentralized and effectively can remove intermediaries. That is valuable for a number of reasons, but it's not the silver bullet for every use case. So often when people talk about tokenization, they talk in binary terms. Something is tokenized, it can never be untokenized. Everything is tokenized, everything in the world is tokenized, or nothing is tokenized. That's not the way that we view the world. So maybe we're bringing it down to dollars, because at the end of the day, I think people understand dollars pretty well because they use dollars every single day. In my mind, for example, a tokenized dollar is an incredible way to move value. But that dollar can also become untokenized. When that dollar is at rest, for example, for most people in the United States, it makes sense for them to hold actually dollars, not tokenized forms of dollars, right? And that's partly because of the regulation in the US. A stable coin, 7% of that has to be backed by short-term treasuries. You're not allowed to do interest, at least not currently. It's not FDIC insured. So I like to draw this distinction that tokenization typically adds value when the money is in motion. It also creates this global connectivity layer, right? As in anybody with a smartphone can access this technology. In the same way that I always like to use this example, for example, like SMS and other mechanisms. When it really exploded was when it created like this distribution to anyone in the world. And also when you created interoperability. So people don't realize this. When text messages started, you could only text people on Verizon if you were on Verizon.
Right.
What really allowed that to explode was when you had kind of the ability to be interoperable across networks. I could send a text message from Verizon to T-Mobile. The same thing's happening with tokenization. Right now, it is this very fragmented technology. Some people are building on Ethereum. Some people are building on Solana. Some people are building on Canton. The connective tissue is now starting to form. And that's what I don't think people truly understand, is that when you make this technology, which has immense value, and you connect it all, that's where you have the unlock. Also, fundamentally, for most people in the world, for example, tokenized dollars have largely been an unusable technology, right? They're pretty complex to use, yet they've been very, very important to a lot of people in the world. So what does that say? There's huge value. And there's huge value about global, instant, real-time movement of value to pretty much anyone with an iPhone or with a phone generally. That's incredibly powerful. So our big focus now is basically solving usability. So we put out a report recently, what we call the Momentum Report around stablecoins. Stablecoins have grown massively. That's why people are so excited about it, because despite it being a largely unusable technology, people are using it. So as we solve usability and reduce friction even further and create connectivity around the world, it's going to explode in terms of usability. So it's really the global network of networks. It's kind of the way that I think about tokenization.
I think it's hard to dispute that stable coins have strengthened the US dollar internationally.
For sure.
Will it be the same with tokenized equities? They would strengthen the US dollar equity market because now, someone in South America, Africa, or wherever will be much easily be able to, access the capital markets through tokenized equities.
Yeah, I mean, tokenization and this infrastructure of blockchain is really a global rail, which one increases access and increases velocity. And access and velocity is what grows GDP. So fundamentally, I think it's good for everyone. I think it's also, of course, it's good for the US economy. I think maybe just bringing it down to something that people might really appreciate is, for example, payroll, right? Talking about global movement. Why does it matter? Like, why does speed matter? Why does velocity matter, right? I think people like to say that speed matters, but why does it really matter? So bringing it back to a use case that I think, again, everybody understands. Payments for payroll. So effectively, I get paid every 2 weeks. The way to think about that is I'm effectively actually providing my company with a loan. Now, I'm fortunate I don't have to worry about that, but I'm effectively providing a loan to my company. 7% of Americans can't afford a $1,000 shock to their system if their card breaks down. Think on a global scale, the amount of people that getting paid and not providing effectively a loan matters. So I think you can get rid of, if you increase velocity, speed, and price, and reduce price, you can pay people more quickly. And that matters to a lot of people. So that's why speed, global infrastructure, as the world becomes more interconnected, the ability to move value more quickly, more cheaply to anyone, anywhere, really matters. And that's bringing it home to a use case that we all understand, which is being paid by our company effectively.
Let's talk a bit about building. So you've been going at it for almost 9 years at this point. What's an early decision you made that you are actually proud of that has had positive ripple effects when it comes to the infrastructure of the company, the way you guys do things?
Yeah, I think it's probably a lot of the core team. So we have this concept at the company of a founding team. This founding team is the people that were there with me from the start. Often founders get the kudos, but really the founding team have been there since day one. And founding team, many of them are some of them are in the C-suite, some of them are mid-level, some of them don't manage anyone, right? They're an IC. But they've set a culture, they've set a tone, and that's why we that's why we created the concept of a founding team, that wherever they are in the company, they drive and instill the value of a founder, which is constantly pushing to be better. So I think a lot of the culture has been set by those people that came in early, and that's been incredibly powerful, especially as the company gets bigger. You travel a lot, you're not as engaged in every single part of the business, but to have these people that really set the tone, set the culture, set the demands, up, down, and across the business, that's been something that's really helped us. Look, we made a lot of mistakes across the last 8-9 years, but that's something that I think I look back with a good amount of pride.
Years ago, I interviewed Enrique Dubugras, founder of Brex, and he talked about this, but he said more important than the early hires is the early leadership hires, because they have more agency in setting the culture. So that was a good decision. How did you connect with these people? So those were early decisions, right? But you could have also gotten it wrong and bringing the wrong people, but it sounds like in many cases you actually brought the right people. Why was that? Did you draw on your existing network? Did you rely on an agency, on friends? Maybe...
Just to be clear, the founding team member isn't the first, for example, 6 people that we hired at the company. It was probably the first 50 people in the company, and 6 of them are founding team members, right?
Yes.
So I think it's an element of a degree of healthy churn, making mistakes along the way, but then the people that really, really are there with you, especially as a founder, sometimes you think that the tough things aren't known by your team. The people know. The story I gave you of effectively having a week's worth of runway, the team knew. They could have gone somewhere else. But I think it's really that desire to build something big and kind of lean on each other. It obviously was a lot easier in that world. It was a COVID and pre-COVID world. We were all together. We're an hour of remote first company. So it is harder, frankly, to build that connective tissue. And that's why we do try to be really, really intentional around sharing information, making sure that we at least get together globally every 12 to 18 months to try and create that connective tissue. But look, we got lucky on it, and we tested it. And once you realize that these people are great and building towards what you want to build, really, really investing in those people and kind of setting the culture from there. But these, just to be clear, these weren't the first 6 magical hires and those are the 6 founding team members. No. It's a good amount of churn from there. And saying we made the concept of founding team member probably about 5-6 years into the journey.
Yeah, I see.
So it wasn't the immediacy.
So flipping the question around, people and talent aside, what's a decision that turned out to be the wrong one that you learned from early in your days that now you look back on?
Yeah, I mean, I think probably there were 1 or 2 investors that weren't good investors. The best advice I got was from a mentor of mine who actually was the person that stepped in when we had a week's worth of runway and did a deal over the weekend, effectively. A gentleman called Tom Sosnoff, who has founded multiple businesses and actually really helped us get to where we are. He really helped me unpack the psychology of investors. These investors were vying for us to effectively sell the business at a $50 million, $75 million valuation.
How many years into the...
Maybe 3 or 4. This was after the tough time. They came in and they said, okay, we've kind of survived, let's kind of get out. And every investor says, I want a 20x, I want a 30x. That's kind of that. They can't say that they don't want that. And he said, look, I'll buy your equity tomorrow at that price. And from that point on, it was a very different piece. But the agitation, the stress that can cause is very, very different. I sometimes envy the stories that, I've listened a lot to Eric at Ramp, for example, talk about some of these early investors that were just incredible. I think we certainly had some absolute standout investors, but there was a balance of not so good investors that can be very, very counterproductive. And that's hard, but you learn the lesson and you say, look, if you don't want to be here, I'll find you an exit.
Right.
And that was the lesson I learned, which was if you don't like, you're not tied in forever, right? This isn't a trap. We can help you find a secondary. We'll help you facilitate a secondary. The company will buy back your equity. And kind of saying to people, look, if you don't like invest, it's easy to kind of moan from the sidelines. It's either be quiet, right, and help, or get off. Those are the two options.
Yes.
It's not about not taking feedback. It's about just negative agitation. And that can be sometimes incredibly damaging.
How should founders, because our audience is definitely a lot of founders, how should founders think about this when they're raising their initial rounds of capital to hopefully avoid those kind of investors?
Yeah, look, it's really hard to get to know people, especially when you're trying to raise money. At the start, it definitely wasn't easy for us to raise money. We're in a very different place now, right? You have optionality. We probably didn't have that many options. You can do reference calls, you can do other pieces. Really, at the end of the day, it's really hard to figure out. I mean, you have to make sure you have the protections in place. What I would say is look at investors that are more focused on displaying influence versus power. And influence is very different to power. And I think once you display power, you actually lose influence. And that was the one or two things that I've learned with investors as well, is if they had power and then they tried to use it, then they frankly lost influence with me, right? So, but if you have investors that are really focused on influence, that tends to be the better investor that's looking for a multi-generation relationship.
Yeah.
Because they understand that if you use that power, it's very, very hard to come back from that, right? But influence, hey, you've done this wrong. This isn't how it should be done. That's great, right? So really talk to them about how do they interact with their founders. Ask them, you really test the relationship when it gets hard, and how have they kind of deployed that? Is it softer influence or the harder power? I think that's an important delineation that I've seen with interactions with many, many different investors over the years. But that's also the power of tokenization, right? If you create more liquidity, your investor doesn't want to be on the cap table.
Get them out.
You can create a market that is easier for illiquid assets, right? When you're earlier stage, it's harder to kind of have that model. So that's the beauty of, for example, blockchain.
It's coming back to the point.
Yeah.
and going back to talking about building, when you are building infrastructure, right? Like there's choices. Well, what do you want to leave to your customers build, and what do you want to build? How did you figure that out with your team? And you still do as you expand into new products.
Yeah, I think with infrastructure as a service, sometimes you can fall into the trap of effectively being a dev shop for your clients. Yes. And that completely strangles you, or maybe a softer term is you get bear hugged by the investor, especially the big customers. What I've learned with SaaS infrastructure is often very hard to know exactly who's going to make you money. Your projections are typically wrong. I think we are much better now of having a very clear vision of exactly what we want to build, what we think makes sense. You've obviously got to be ultra responsive to customers and features. And look, if somebody wants an API filled and that means a lot to them, and it takes an engineer half a day, let's do that. But that shouldn't be 100% of how your roadmap is mapped. Roughly now we basically allocate about 20% of the roadmap to being highly responsive, highly reactive to customers, showing that kind of investment and creating stickiness. That is the great thing of being ultra responsive to customers, is that they become stickier and stickier and stickier, but also being clear of the roadmap that you want to build, and not falling into the trap of being effectively an outsourced dev shop.
How about pricing your product? What did you learn? Because with infrastructure, it's not always easy.
Yeah, probably one of the best decisions we made was our pricing decision. And I remember a lot of debate about it. With infrastructure, typically, and if you look at public companies with infrastructure, typically about 80% of the revenue will come from 20% of the customers. So you've really got to make sure that you share in the upside of your customers. So the way that we price is that we have a monthly minimum, and then we basically have a usage component based on the volume that's sent through the system. If you'd created like an all-you-can-eat model, you just wouldn't share in the upside, and so you'd have a very, very, very fragmented customer base. It also creates good alignment, right? If you share in the upside with customers, that makes a lot of sense. So that would be one thing. Is in infrastructure, you've really got to try it, whether it be number of API calls or something. You've got to share in that model. I think that's probably the key piece. The second is we try to really focus on value, not price. We are not the cheapest. We will never be the cheapest, and we haven't been the cheapest. What we focus on is value. One, I think you want customers that really appreciate the value that you provide. And if you sell to those businesses, they're stickier. There'll always be somebody. It's very easy competition if you just go cheaper, right? Somebody can always be cheaper than you. But making sure that you really understand what is your value proposition. And by not being the cheapest, it forces you to actually sell to customers that understand your value proposition a lot stronger. Our chief business officer sometimes says no business is better than bad business. And I think it's actually true. You've got to make sure that you invest in the right relationships, especially with an infrastructure like ours where we're a regulated business, right? You've got to make sure that you're working with people that you want to work with. We've always been very, very clear on those points.
How often are you rejecting customers because you think they're not ready to work with you?
Yeah, I would probably frame it as not rejection, but kind of, there's softer framings that you can do. Look, I always say, we don't let price come in the way of a customer that we want, but it's probably quite regularly now where we feel that the customer isn't right for what we're trying to build. That's okay. So it's I wouldn't have an exact number, but I think we're willing to turn down business.
Not just for pricing.
No, not just for pricing. Whether there's when you're a regulated business like us, we're not just a technology infrastructure business. We're ultimately a regulated business. And for us, we're trying to build this business for multiple generations. We're trying to have true impact and where we know that we can have impact is on customers that care about doing the right thing, building on strong infrastructure, not just price. And that's kind of the way that we think and have frankly always thought since we kind of helped define this. No one was doing crypto or stablecoins as a service. No one was doing tokenization as a service. So as we really thought about as we've expanded our product suite is making sure that you do have that upside and you're invested in the right partners. So that's the key.
When it comes to defensibility, how do you think about it?
Trust for us is our biggest defensibility. And trust can mean a lot of things. It can mean, do you have the right regulatory structure? Do you have the right cybersecurity posture? But for trust, that is the biggest barrier to entry. And I think that's kind of shifted. I think sometimes people think that our business is focused around regulatory barriers. Yes, we're super regulated around the world. Those things can move pretty quickly, right? In the US, an OCC charter is definitely possible for more and more businesses. But really what we're focused on is trust, especially an emergent asset class like this, an emergent technology like this. Our goal is to ensure that there's not a zero-sum trade-off for our partners between trust and innovation. And everyone expects the startup to be innovative and help them on that side, but really making sure that you can be trusted, especially when you're selling to financial institutions, right? A lot of decisions are made through a risk lens, a CYA lens. Really making sure that our proposition around trust is absolutely our critical moat.
Before we run out of time, I want to go into kind of quick rapid fire set of questions.
Yeah.
What's a company metric that you watch obsessively and why?
Honestly, revenue. That is maybe an odd number to say, but for us, it's revenue gives us strength. I mean, I track it literally every day.
Can you share maybe some stats around it?
Yeah, I mean, look, our revenue, we've grown revenue year on year over the last 3 years. But I just, our business is a transactional business. Yes. So literally you can track how much you're making in real time. And that's something that I look at. One other metric that I'm building actually right now is I don't think churn is all equal, right? So I basically have created this with the team, effectively a metric based, basically, if you look at churn, there's always going to be churn in a company, but weighting that by how that employee is doing from a performance perspective. So if somebody churns that is a high performer, that should weight more towards your number. Most people say, well, what's your churn? It's 5%, 10%, whatever the number is. But I want to weight it based on that strength of that person.
What's a book you often gift or you often recommend?
Yeah, maybe I actually just wrote a book, Stablecoins for Babies. So that is probably
there
the book. Go. That's the book that I give away to pretty much everyone that has a kid that I know was expecting a kid, and it's been a great thing. Like, there's nothing better than having your kid pick up your own book. It's just amazing.
And we're on the age where our friends are having kids.
Exactly, it's a great way to connect with people as well.
Who's a leader you admire, and what have you tried to steal from them or mimic?
Probably, I mentioned Tom Sosnos, right? Just probably the thing that I've tried to learn is, I think he was founder mode before founder mode even became a term. I remember, he would reply to customer information, customer requests, customer questions, and just forward them to me at 9 p.m. on a Sunday, and expect me to reply. This is a person that's built multi-billion-dollar businesses, way bigger than we were. It's like, wow, okay, that intensity kind of sets a tone. That sets a tone, right?
What's one habit that has materially improved your effectiveness as a leader?
I massage every week. It gives me space to think. It's very, very hard to actively think these days. Constantly, your phone's always next to you. Even on a run, you've got your phone on you. You've got an Apple Watch on you. Massage, you literally can't be on your phone. So it helps me process things much more quickly.
If you weren't building ZeroHash, is there any problem that you're also obsessed about these days?
Probably health, right? If you think about just global health, I think it's something that it affects every single person in the world, right? So that's, for me, it's about most amount of surface area globally that you can touch. I think finance, everybody has money, everybody gets paid, everybody also worries about their health.
And final question, if things work out for ZeroHash within the next 5 years, where are you going to be?
We want to intersect with, billions of people globally, and we want to touch, and provide infrastructure to those people. So really, we want to have surface area of 20 to 50% of the world's global population is intersecting on our rails in some capacity. And I truly, truly believe that will be the case.
Amazing. Well, I'm glad we recorded this on one of the coldest days in New York City in decades. So thank you for doing this. And again, hats off to you for rejecting a $2 billion acquisition.
Thank you.
Thanks for tuning in. I hope you enjoyed this great episode with Edward from ZeroHash. If you want more episodes, make sure to subscribe and leave a review on Apple, Spotify, or YouTube. And if you have any suggestions or thoughts about the show, just drop me a line on LinkedIn or send me an email. Thanks, and I'll see you in the next one.